For some, the global financial crisis was a disaster. Others learned to move on and profit from the brave new financial world. Which group would you rather be in? I'd like to be in the second group, I hear you say. Well, keep watching, and you could be. You see, before 2008, as long as they had a fair amount of cash equity, property developers used to get their funding from the banks, which suited the banks very well, because it paid a great return and was lower risk than other types of lending, thanks to the lending being secured on the property. But if ordinary people like you and me wanted to access this wonderfully profitable market, we had to buy into things like shares, unit trusts, or real estate investment trusts known as REITs, which meant, 1, we didn't have a choice which properties we invested in, and 2, we took on all the risks of the stock market. But then, in 2008, the entire financial world changed forever. The regulator made it much more expensive for the banks to lend on real estate developments. They still find it extremely attractive, but where they used to lend up to 75% of the value, they now really struggle to lend more than 60%. And this can leave a funding gap for developers. Here. Which is the good news you, the investor, have been waiting for. Because capital stackers spotted the opportunity very early on. For crowdfunders like you to work hand in hand with the banks, bringing investors, developers and banks together in one online platform to fill the funding gap, building on the bank's risk assessment and due diligence and adding our own for extra security. So this allows the banks to do their job, funding the construction and keeping the project liquid until it's complete. And it lets the developers do their job, building new properties at a time when we need more housing, while giving a new type of opportunity to investors hungry for better returns. So just in case you missed how important this peer-to-peer finance revolution is, let's cover that main point again. Ordinary folk who have anything from £5,000 upwards in cash join the bankers in lending to developers to make typical annualised returns of 10 to 20% by giving loans secured on property while it's being built. So you can see, whilst the returns can be high, the risk is no more than the banks have been building their investments on for years. So how exactly does capital stackers work? Well, if a building costs X to build and is worth Y when it's complete, the profit created is what makes the deal work for everyone. But first, we expect the developer to have some skin in the game, which usually means he'll put in at least 10%. Next, Capital Stackers helps find a bank to provide the ongoing construction finance. And this gap between what the bank is able to lend and the developer's equity is where you and the other Capital Stackers investors can get involved and make double-digit returns. What measures does Capital Stackers take to protect your investment? Capital Stackers will not publish any deal on the platform or ask investors to bid for the parts of the loan stack until the risk has been thoroughly assessed by 1. The bank, and 2. Capital Stackers' own risk analysis team. And only after we've 1. Raised the total amount the developer needs to finish the project, and 2. Completed the legal analysis and received the title checks and formal reports from the professional valuer and monitoring surveyor, which can take up to 4 weeks, are you asked to transfer the amount you've pledged. These funds are held in an FCA-regulated client account separate from the developers and capital stackers accounts, until we're fully satisfied with the independent due diligence carried out by professional surveyors and valuers. Only then can the developer draw down on his capital stacker's loan, and you start earning money from this point until it's repaid in full. So how do you choose your own risk and return figure? One of the benefits of working with capital stackers is you can choose the percentage of return that you want. To achieve this, you choose the level of risk you're happy to take. Confused? Let us explain. The capital stack, that's the total amount to be loaned by our investors, is divided into different levels. So layer 1 is the lowest risk level. In this example, it has the lowest level of risk at 60% loan to value, and consequently the lowest return, typically 10% per annum. This layer would appeal to somebody with a lower risk preference, such as a pension fund investor. Layer 2 has a 67% loan to value, so it pays a higher return of 12%. And layer 3 has the highest risk, loan to value ratio being 75%, but the highest return at 16%. Not forgetting, of course, that the investments are secured on the property being built. Of course, you can always choose to spread your investment between different layers to give yourself a good mix of risk and reward, but usually the minimum you can expect is a double-digit return. And all in the time it takes to build a row of houses. Once you've invested in capital stackers, how do you get repaid? As soon as a project funded by capital stackers is complete, everyone gets paid in order. Since the bank takes the first charge security on the property, they get repaid first. The security trustee acting for you, the investors, takes the second charge, meaning you get paid next, after the bank, but before the creditors and the developer. So capital stackers are paid in order of how high up the risk stack they are. First, after the bank. Layer 1 investors, lowest risk and lowest return, are repaid their capital plus interest. Then layer 2 investors, then our highest risk layer. Only then does capital stackers take its margin and exit fee. And finally, once everyone else has been repaid, the developer will get back his equity and receive his profit. There are no hidden costs or charges for investors, so the annualized return on an investment is the return that you agreed at the beginning. In other words, the interest rate you see is exactly what you get. So now, at last, ordinary investors with as little as £5,000 to build on have access to an investment that used to only be open to the most wealthy, is run with complete transparency and rigorous risk assessment. And lets you choose what level of risk you want to take and what double-digit return in just the time it takes to build a row of houses. So join the capital stackers crowd today, because if the bankers can make money from property, so can you.